Good day. Thanks for joining us to talk about life insurance. I'm Carol Roberts, the Community Resource Development Agent at the University of Florida IFAS Extension in St. Lucie County. We're going to cover the basics of life insurance today. We're going to talk about the different types of life insurance that you can buy and how to choose the right policy and the right coverage for your needs and your family's needs. So let's get started. I love this famous quote from Benjamin Franklin. In this world, nothing can be said to be certain except death and taxes. Insurance is a tool that we use to help alleviate some of the impacts of life's certainties and uncertainties. Consider you buy health insurance in case you get sick, right? Because you know there's going to be a cost involved in that in getting well. You might buy auto insurance because you might worry about having an accident. And the cost involved in recovering from an accident sometimes is more than we have in our pockets. We buy homeowners insurance in case our property gets damaged, right? But we don't buy life insurance to plan for our death. We buy life insurance to plan for what happens after our death. Let's talk about that. So life insurance is a contract that you purchase, and its purpose is to protect the people who depend on you and the people that would suffer a financial loss when you are gone. And I say you as the major breadwinner in the family is who we're trying to protect, because if that person's gone, the rest of the family may suffer. When you buy life insurance, you designate a beneficiary to receive the death benefit on that insurance policy. That beneficiary is the person or legal entity that you designate to receive that death benefit, and you are certain that that person will distribute the death benefit as needed for the rest of your family. So as I mentioned, life insurance is not to plan for our death, but to plan for what happens after our death. So usually people buy life insurance to protect their children, a surviving spouse, a disabled relative, or maybe an elderly parent who relies on us and our income for their care. So it ensures that those dependent family members will be able to afford to live and maintain their current lifestyle and receive the care that they need after the breadwinner or the provider of those services is gone. What we don't want to do, or we usually don't do, is insure the family members who are not the breadwinners. Yes, it's a big impact if we lose a child. There's going to be funeral expenses and so much emotional heartache to deal with. However, if a child of the family is lost, it doesn't result in a loss of income going forward. And life insurance is, the purpose of life insurance is to cover the loss of income and the loss of care and help maintain a lifestyle that those family members have been used to. There are several reasons to purchase life insurance, and I guess you could guess a few of them by what we've already talked about. But yes, we don't buy life insurance to plan for our death, but for what's going to happen after our death, like perhaps the costly funeral expenses that our family may face, or other pressing debts like immediate car payment debts, or other loans. Your death benefit actually is tax-free income because the premiums, the payments made for that life insurance, they're called premiums, those are paid with after-tax dollars. So the death benefit has already, according to the government, the death benefit has already been taxed. So the death benefit, when paid, should be tax-free. You can make sure that you have purchased enough life insurance to pay off an outstanding mortgage or other loans that would be difficult to pay if the breadwinner's income was lost. You can make sure that you purchase enough life insurance, enough of a death benefit to cover any housekeeping or childcare services so that a surviving spouse can go back to work, maybe even make sure that that person can pay for education to ensure that they're a viable member of the workforce. Perhaps that surviving spouse really needs to stay home or not work full time because of other family commitments. You want to make sure that your life insurance death benefit could cover the cost of that type of situation. And you want to provide your dependents with an emergency fund. If the major breadwinner's income is lost, there may be some outstanding expenses and future expenses that would be hard to deal with. So building an emergency fund or providing emergency fund for your family members is a smart thing to do. So how does this whole life insurance thing work? Well, like I mentioned, it's a legally binding contract between an insurance company, the insurer, and an individual, the insured person. In exchange for the payment of premiums, that insured has to pay a monthly payment or a scheduled payment to keep the policy in force. Those are called premiums. Then the insurer agrees to pay a specific death benefit, and the premiums collected from all policyholders are placed in an insurance pool. That's the nice thing, that insurance companies, some insurance policies, can create their own income for you. So yes, the insurance company has to hold a certain amount of the premiums that are paid to them by their insureds so that they could pay out death benefits to a certain percentage of their customers instantly. That's a law. So they have to keep a certain amount of funds on hand to pay the death benefits. And then the money that they don't have to keep on hand to pay off those death benefits, that insurance company can invest in the stock market and other kinds of investment tools. They can't expend all of their funds in investment, but they can use those investments to build the strength of their company and perhaps provide you a little bit of income or inflate the death benefit or the value of your insurance policy, depending on the type of life insurance policy that you purchase. That may be an option for you. Just like you, the insurance company wants to make sure that they protect themselves from loss. So they want to insure low-risk people. If someone dies too quickly after buying an insurance policy, they haven't paid enough premiums for the insurance company to recover some of those dollars before having to disperse the death benefit. So they want to make sure that people live long enough to pay some of those premiums to cover the loss, right? That makes sense. So they're looking for low-risk people. So how do insurance companies determine who is a low risk? Well, there's a process called underwriting. It's the underwriter's job to make sure that the insurance company doesn't take on too much risk. So they want to know things about their potential insureds. They'll ask and want to know about your present health. How healthy are you? Do you exercise? Do you smoke? Things like that. They want to know about your past medical history. How healthy have you been? Have you had a lot of surgeries? Have you been taking care of yourself? What about your family? Do certain diseases or conditions tend to run in your family? They want to know that. They're protecting themselves from loss, right? They also want to know about your lifestyle. Are you an accountant type person who sits behind a desk? Or do you drive race cars for a living? That's going to make a difference. Do you like to dive and jump out of airplanes for fun? Is that your lifestyle? Or are you more of a card player and putt-putt golfer? Those kind of things make a difference in the insured's assessment of risk. So what they do, the underwriters look at all that information and then they put it all together using a lot of data and averages and historical information to rate a mortality level. And if someone is expected to live a long time based on that history and information, then they're placed into a better premium class that results in lower premiums for the policy. So the less risky the insurance company feels you are, the less you'll pay for that insurance policy. In fact, I am a certified diver. When I applied for a life insurance policy, I had to disclose that I was a diver, and there was a little bit of extra income or extra payment that I needed to make because I was perceived as a little bit higher risk than someone who doesn't dive. I had to sign a rider that said this, yes, I do dive, and they made considerations for that. That put me in a different premium class. So the healthier you are, the low risk you are perceived to be, the lower your premiums will be. That means that's something to bring up is the younger you are, when you apply for a life insurance policy, the more likely you'll be to have lower premiums. So you go through all that information, and the insurance company says, all right, you're a risk that we're willing to take on. What kind of policy would you like? There are two types of life insurance policies. There's term insurance and there's permanent insurance. Let's talk about the difference between each of those so we can understand which type of policy might be most appropriate for ourselves. Term life insurance is a good tool for a lot of people because it's very simple and it's usually very inexpensive. Some companies will say, go for term life insurance and invest the rest, because permanent life insurance is more costly. Term life insurance is a policy that has a specific term or length of time that it's valid. That period of time is usually, it can be anywhere from 1 year up to 30 years. You pay a set premium, a monthly payment or a set payment to keep that term life insurance policy in force for the term selected. If you happen to die during that term, the life insurance company will pay the death benefit. If you do not happen to pass away during the term period, you have paid for a term policy that you didn't use. Some term life insurance policies can be purchased with a return on premium feature, which is called ROP, which means that if you live through the entire term and never need to use the life insurance, you lived through the entire policy, the insurance company may return a certain percentage of the term payments that you made. You would want to talk to your insurance agent about that return on premium ability. It will cost a little bit more than basic term, but it can provide you a return on the premium if you don't use it. So that's one feature. Why do people buy term life insurance if it can expire before they do? Well, some people are determined that they're going to be successful in life, or maybe they know they are, and they just need this little guarantee, this cushion to protect their family while they build their business or their career. And they know that in the future, when that term is over, that they should be in a financial position sufficient to support their family after they're gone. So maybe they've got a six-figure salary, or they're working towards a six-figure salary, and they know that 20 years from now, they're going to have enough in savings that their family will not suffer if their income is lost. You see what I'm saying? And the alternative to that is permanent life insurance. It's just what it says. It's for the remainder of your life. In fact, up till age 100. If you happen to live to 100, woohoo for you. The insurance company is going to pay you your death benefit, and you get to either put that in a savings account or have a big party for all of your family and say, guess what? I made it to 100 years old. There are three basic types of permanent life insurance, and I'm not going to go into the difference between a whole life, a universal life, and a variable life. You would want to talk to your insurance agent about that and how each of those different types of permanent insurance might work for you. But basically, it covers you. There is no term. It just covers you until you die or turn 100. Permanent life insurance also has the benefit of having a cash value. So as you pay your premiums and your insurance company invests, those investments and contributions inflate the death benefit and can actually help pay the premium for the policy depending on the type of policy you have. And as the death benefit increases because of that, you're allowed on some policies to take a loan out on your death benefit that you can pay back at usually a lower interest rate than your bank can provide. And if you happen to pass before the loan's paid off, then your death benefit's reduced by that loan amount, and it can be a way to get some extra income for perhaps a down payment on an automobile or home, something like that. So it is a tool you can use while you're still alive. And if you happen to be not interested in owning your life insurance policy anymore, you can cash it in for the cash value that it's accumulated. So there is an automatic return on premium like some term life insurance policies. So there is a cash value that you can retain while you're still alive. Also the dividends, those investments that your insurance company makes, they can come back to you, depending on the type of policy, as a quarterly or annual stream of income. So there are some different tools that permanent life insurance can provide. No matter what type of policy you choose, permanent or term, you want to make sure that you're not underinsured and that you're not overinsured. So things you might want to consider when you're looking at how much life insurance you should have, how much of a death benefit you should select. Look at the number of dependents you have in your family. Who's likely to need to be cared for? How much is it going to cost to care for them until they're old enough to take care of themselves? What are their ages and their needs? Are there any special needs in your family? What about what you still owe on your home or what it costs to live in your home? You might want to consider how it would cost to make sure that the rest of your family could pay that payment for a specific period of time, 6 months, 12 months, until they got on their feet. You also want to look at the balance of your mortgage and those loans. Could you pay them off? Could you purchase enough life insurance that loans could be completely paid off, auto loans, things like that, so you don't lose a car that you've invested a few years of payments into? Health insurance. Are you the insured, the health insurance provider through your employment? You might need to consider making sure there's enough for the rest of your family to pay for health insurance if you're not providing it for them. And tuition. What about those dependents and their future educational needs? You might want to consider making sure that there's enough of a death benefit to pay for some tuition so your children can go to college. There's a lot to consider in the costs of these different factors, but it's good to think about it and then make sure that you have sufficient death benefit allotments to cover what you deem is important for your family's future. And make sure that you're not spending too much of your income paying for too much life insurance, more than your family might need. So we've looked at the purpose of life insurance, what it's supposed to cover, and the types of policies you can get. Let's talk about now, if you're sold on life insurance, where do you get it? Well, your employer may offer that it as a benefit. Several employers do. You may check with your HR department to find out if you have that benefit. But keep in mind, employers usually offer term policies that are canceled as soon as you leave that place of employment. So those, you may need to buy an insurance policy outside of your employer. Some insurance companies sell insurance through experienced agents, and you may find connections to those through your bank. You can look them insurance companies up through the internet. Your current health or auto insurance provider may also be connected with a life insurance company or life insurance policies. So you may check with them. But whichever life insurance company you go with, you want to make sure that you check the ratings of those companies, the stability of those companies at ambest.com. That's one of the best sites on the web to rate life insurance companies. So make sure you do your due diligence before you start paying premiums to a life insurance company. They do a great job, but make sure you're working with a reputable one. So, life insurance, I don't mean to bring you down. We all know that there's the one guarantee in life, right? So we now know we don't buy life insurance for ourselves. We buy it for the people we care about. We want to make sure that they're able to move forward if we're not there to support them. I love this image of the life insurance in place of the provider who's missing. So choose the type that suits your needs and your budget and your plans for the future. And then balance your investment to return. Make sure you're not overinsured and underinsured. Your insurance agent should be able to help you to find the appropriate balance there. If you have any questions, feel free to call your county extension office. I'm Carol Roberts, the Community Resource Development Agent at the St. Lucie County Extension Office. It's been my pleasure to talk to you about life insurance today. If you need any further information, scroll back to the beginning of this video, and my phone number and email are on the very beginning of this presentation. Would love to hear from you, and look forward to your comments. Thank you, and I hope you join me again for a future segment.